welcome to another edition of Smart Money. Since the markets have been under pressure and on a selling spree, we thought about focusing on investment ideas while the markets fall. Today we speak about index funds. What are the reasons to invest in index funds? What should one look for while building a portfolio? And what are the good index funds to look at? To answer all of these questions, we have Radhika Gupta, the MD and CEO of Edelweiss Asset Management, who joins in now. Radhika, thanks so much for joining us on the show. You know, index funds have suddenly become very popular. Do you want to first revisit the basics for new investors who are watching you right now? What are the key reasons to invest into index funds?
Thanks, Sonia, and good afternoon to all your viewers. So I think, in the last 18 months, you've seen a lot of new investors, and they could be young or old, doesn't matter, come into the market. And very frequently, they'll ask the question, I need a simple and basic product to get started. And while there is a wide range of mutual fund categories out there and individual schemes within categories, selection is a difficult thing. If I was to go out and pick an equity index fund today, do I pick a large cap category or do I pick a flexi cap category or a multi-cap category? Within that, there are 40 AMCs and 40, so many schemes, etc. I think index funds are a simple way to get started with exposure to market. With index funds, you don't have to worry about beating the market, which stocks to choose. You're at least participating in the market. So I think index funds are step one to investing. They let you participate in the market in a simple, predictable and reasonably cost-efficient way. And I think that's the number one reason to look at index funds. In the past there have been lots of debates about active, passive, alpha. I actually don't think any of that matters. I think it's about simplicity and consistency, just not having the problem of choice and starting out by participating in the market.
Especially a lot of those young investors who are kick-starting their investment career, right? Because I mean, if you're in college or if you have a job, you may not have the time to do the research, so might as well just invest in an index fund. All right, so just to understand the basics a little more, Radhika, what should I look for if I am going in for an index fund?
So I think, as the name suggests, the most important thing in an index fund is the index, and the index is essentially a construct. It's a set of rules that is published by a registered index provider in India. It could be BSE, NSE, CRISIL, MSCI. That determines what the fund will do, because this sounds very basic, but an index fund's job is to replicate an index. And the reason I'm talking about this is, if you're looking at an index fund, please understand the underlying index well. For instance, you have indices like the Nifty, which is the top 50 stocks. You have the Midcap 150, which is the top 150 midcap stocks. You have the large and Midcap 250, which is 250 stocks. The index fund will be as good as the index. The return of the index fund will be the index return minus fees minus some tracking error. So that's very important. It's also important to understand this, Sonia, because sometimes there's a perception that index funds are risk-free. Index funds are as risky as the underlying index. So if you're buying a small cap index fund, it carries small cap index risk. In an active fund, it may outperform, it may underperform the index, but in an index fund, you will get the index. Do also note that all index funds are not only equity. There is a wide market of debt index funds, Bharat Bond and many others out there. So today with index funds, you have equity index funds, you have debt index funds. It's important to go out, and you have international index funds. So it's important to go out and understand the index.
Okay, and that's why we have you here, so that you can explain to us the difference between all of these funds, right? Let's start between active and passive funds, all right? What is the exact difference between active and passive funds? And if you can explain to our viewers, what is the potential here?
Sure. So I think an active fund is a fund. So let's start with an index fund. An index fund of large cap companies typically tracks an index like the Nifty. Your portfolio, if you give me 100 rupees, will be equally divided in stocks in the Nifty basis the Nifty weights, whatever they are. There is no selection that any fund manager is doing. That's a passively managed fund or an index fund that tracks an index. An actively managed fund now is where a fund manager's role will come in. So the universe could be the same 50 or 100 large cap companies, but the fund manager will take a decision as to which companies he wants to hold basis his view and which companies he doesn't want to hold. The belief is, of course, in the long term, a fund manager's intervention should add value over the index returns. But as I said, it's a problem of choice. So if you just want to hold the market, to meet the market, you hold an index fund. As you evolve, when you want to think about beating the market, or in certain categories like mid-cap, where you think your fund manager is really going to do a lot of stock selection, you might want to do an active fund. So there's no either or answer. It's about meeting the market and then eventually getting products that are a subset.
So if I'm planning my portfolio, Radhika, when do I go active and when do I go passive in my investing?
So I don't think it's either or. I think actually you do both. I mean, I give the example of dining here. It sounds like a funny analogy. If you're an Italian food lover, chances are there are days you're going to eat at Pizza Express because you're traveling in a random, foreign country and you just want a consistent place that you're used to. And there are days that you're going to go to a fine dining Italian restaurant because you want that chef to wow you with that kind of meal. So I think actually the answer for most people's portfolio is a mix. I think in certain simple and basic categories, core portfolio holdings like large cap, fixed income, etc., index funds work really well. In certain categories like mid and small cap, I think active funds have their place. So I think the answer is actually not either or. You can build a portfolio of both. What's very important to understand is that both contain the same underlying element of risk.
Okay, so both contain the same underlying element of risk. I do want to talk a little bit about Edelweiss's new index fund, which is the mid and large cap index fund. So I'll talk about that in greater detail. But before that, I wanted to understand what is a core and satellite approach and how can I use that to build a strong portfolio?
So I think core and satellite is super important because what viewers are going to see is more and more product launches, both active and passive these days. In fact, there have probably been 100 plus NFOs this year. You can't choose everything. Every restaurant that opens in town, you're not going to go eat. You'll obviously fall sick. What you need to do is, I think 70-80% of your portfolio has to be basic stuff, what I call the dal chawal of life. And that has to have your basic equity, your basic domestic equity, your basic fixed income, Indian fixed income, and maybe some international investing component. That is 80% of what you do. Then you can supplement 20%, Sonia, with any interesting thematic idea or some, exotic international idea or anything else that you want. So this core satellite approach is a way to say that 80% of my money is going to go into basic, simple stuff. Index funds can play a great role here. For instance, you can build a really nice core portfolio with something like a large and mid-cap fund plus a nice debt index fund. So you've got your basic asset allocation done, maybe a nice US market index fund. Combine these three and you've got a basic core portfolio, and then you can add satellite funds on top of that. So that's a simple way for a newcomer to go about building their portfolio.
And what about ETFs? What should the percentage of your portfolio be? What should the allocation be towards ETFs?
So ETFs and index funds, you have to understand, are sister products. They actually do exactly the same thing with one difference. Both of them track the underlying index, and there's a lot of confusion on this. The thing is, ETFs work like a stock, so they trade on the exchange. The advantage they have is they have intraday pricing, and you need a demat account to buy them. Index funds work like a mutual fund. For most investors, I find index funds are more convenient because you don't need to hold a demat account. You can do things like SIP, STP, all those features that we are familiar with. For traders, sometimes ETFs tend to be more convenient because you have the merit of intraday pricing. But for the same nifty product, for instance, it's very likely that the market will have an ETF solution and an index fund solution. They're really both the same. You need to pick the one that solves for your purpose.
Okay, well, many more questions for you, Radhika. So what we're going to do is we're going to take a short commercial break, but don't go anywhere. Lots more coming up on Smart Money in just a bit. Welcome back. You're still watching Smart Money on CNBC TV 18. We're revisiting a topic today that is old but gold. What is index funds and how you can use index funds to build a strong portfolio. Radhika Gupta of Edelweiss is with us. Radhika, you explained the basics before the break, but let's talk about Edelweiss's fund. Can you give us some details on the Edelweiss large and mid-cap index fund and what is in it for investors?
Sure. So I think this is meant, as we talked core and satellite, this is meant as a simple starter equity fund, a very much a core portfolio solution for anyone who is looking to get started in the market. The genesis was a lot of people come to us, young investors, first time investors, and say, I'm looking to get started in the market. I don't know how much large cap to do. I don't know how much mid cap to do. Give me one fund that solves all my problem. We packaged it into this. The index here is the large and mid cap 250. If you give me 100 rupees here, 50 rupees go into large caps, which is your top 100 companies. The rest of the 50 rupees go into mid caps, which is the next 150 companies. So in a single product, you have exposure to 250 companies. And the beauty of this index is most indices are market cap weighted. So even in an index like NSE 500, you actually hardly get mid cap exposure. Here you get an equal amount of large cap and an equal amount of mid cap exposure. I think for consumers, what really matters is everyone likes the stability of large caps, but you also know the wealth creation that mid cap companies give. So it's combined into a single, very, very simple product. And as I said, it's meant to be a starter solution for everyone.
Okay, so it's a starter solution for everyone. Can you tell us about the index constituents? I mean, if I do invest in this, what all will I have an exposure to?
Okay, so you'll have an exposure to all the big names. I think, as I said, the construction was very unique about, so you'll have an exposure to all your big tech, financial services, energy, etc. names. Compared to traditional indices, what will be different is two things. One, as I said, you will have 50-50 exposure. So you will have 50% large cap exposure, 50% mid cap exposure. The other thing is, if you look at an index like Nifty, about 30-35% of that index is financials. That portion will be much less in this. So the sector allocation will be much better diversified. So you're also going to get much more diversified sector exposure. Some of the newer age sectors also, which are well represented in the mid cap index, will show up here.
So I do notice, you know, there's the graph on the screen, or rather the list of the stocks on the screen. You do have a lot of stocks that have been huge wealth creators for investors in the past. So whether it's a Mindtree, whether it's an SRF, you know, even some of the larger guys. Don't you think the story has played out in its entirety here for some of these stocks, Radhika, or do you think there's still a lot more to go?
So I think, you know, I don't look at it as stock specific. I think one of the elements of index funds is I look at the fundamental construction that, you know, if you look at the top 250 companies in India, they drive a significant amount of the wealth creation and capital market activity. And I think there is actually a sweet spot in those next 150 companies that comprise the mid-cap index. Today, it's some of the names you mentioned. Tomorrow, there will be other names that come. The great thing about index funds is that because it's index links, companies make it into the index, companies make it out of the index. But I think the fundamental segment that we're talking about here, you know, is really at the heart of capital markets and the wealth creation that you see.
So you're saying that there is no real sectoral approach in these index funds, right? I mean, you just sort of map the benchmark, and whatever are the companies that sort of take the benchmark higher and make the benchmark grow, those are the companies that you invest in.
Absolutely, and it's exactly that. It's meeting the market. So that's why the most important element here is understanding the benchmark well. And if this is the benchmark, the index fund's job is to map the benchmark. It's very important to understand the nature of the benchmark. And as I said here, the key elements of the benchmark are 250 companies, equal weight to large cap and mid cap, less diversified, less concentrated sectoral exposure, especially in terms of financial services as a sector and a lot of new age sectors. But the idea is really for an investor to be focused on knowing the benchmark and just investing. I'm hoping that an index fund investor actually doesn't have to look at the stocks their portfolio holds. You can look at the stocks, but I'm hoping this is a fill it, shut it, forget it kind of solution where you're just saying I'm investing in the best 250 top companies in India, and you know, that's what it is.
Okay, got that. Now, since there are a lot of new investors and a lot of millennials do watch our show on digital as well, on the digital space, just wanted to understand, is there any minimum investment required in this fund? And if yes, what is the exit load that I would have to see? What are the returns that I can expect over the near term? If you do, just want to give out those basic details.
Sure. So this is an NFO that closes today, but then it reopens for subscription again. This fund does not have an exit load, so that is, usually a nice fact for that investor base. And I think the minimum ticket size is 5,000 rupees, so it's very, very small. So it starts very small. So it is meant to be a very widely accessible fund, available, of course, on all digital platforms out there. And as I said, it's an NFO, but it reopens for subscription very, very soon.
Okay, got that. So Radhika, we talked a lot about this fund, and of course you are talking about how if you benchmark against the index, you're just securing your future, and there's not much to think. It sort of sorts out your investments for you. What do you do in a market like this where the run-up has been so high and now we're starting to see a correction? So by the end of this week, the Nifty would have corrected about 10% from the peak. What's your advice to investors at such a stage?
I think a couple of things, and 10% from the peak and perhaps single stocks even more. I think one is you have to keep your core portfolio asset allocation intact. I use that core portfolio word because we talked about it. I think, in this market, Sonia, there is a temptation to let asset allocation get the better of you. FOMO is a very, very powerful force. You take more risk than you can. This is a time to really think about the kind of money you have on the equity side and the kind of money you have on the fixed income side. And I always believe it's never equity alone. Equity and fixed income work hand in hand. So that element of asset allocation is extremely important for investors. Second thing is, I think it's very important to remember what you're investing in. If you're doing index funds, of course, it's very simple. If you're doing actively managed funds or picking stocks yourself, which a lot of people do, then I think quality is very important. Whenever the market runs up, everything does well. But it's in periods and periods like this where you see cracks in poor quality names. So I think focus on the kind of quality in the portfolio. And I think thirdly, hold on to the long term. I know many investors are first time investors. This may be their first correction that they're seeing. Markets are ultimately about having a 5-7 year horizon because companies really deliver over that horizon. So 5 days can't make you nervous.
Oh, absolutely. And we haven't got a correction in the last 1.5 years, right? So it was perhaps long overdue, the kind of sell-off that we're seeing in the market now. You spoke about investment in active mutual funds and how, how you should go about that. What is your advice if a person wants to sort of use this dip as a buying opportunity? Does it make sense to put money to work in small cap, mid cap mutual funds? Because the mutual fund manager will of course pick the quality stocks in the broader markets. Or do you think that it's just safer at times like this to stick to large cap mutual funds?
I think it's very individual specific, very, very allocation specific. I do think the core of people's portfolio is either products like large and mid cap or even balanced advantage funds. I love that category because I feel in these kind of markets where markets have run up so much and you are looking for downside protection, that element of equity and debt works really well for everyone. I think it's a great startup product. I think mid and small cap is something to add if you have the risk appetite. It can't be the core of your asset allocation.
All right. Well, it was a pleasure speaking to you, Radhika. Thank you so much for explaining to us. Sometimes, we need to revisit the basics, right? We tend to forget the basics when there is so much volatility in the market. So I'm glad we had this session today. It's much needed, as you said, for all those investors who have just entered the market and not seen a major correction. So thank you so much for joining us.
Thank you.
All right. Well, with that, it is a wrap on another edition of Smart Money. Thanks so much for watching. Do stay tuned in to CNBC TV 18 for all the market action.